Just wait a few moments for some more people to join. Hello, everybody. Welcome to this session on labour transition in the MENA region, a very timely and topical subject as we're heading in the final phases of LIBOR as a reference rate. It's a pleasure to be joined by industry experts to help with this presentation. First, Keith Taylor, who is the Managing Director of the Loan Market Association. Many of you have probably not had direct interaction with the LMA, but you'll all be aware of its significance and influence on the loan markets internationally, but also as well as in our region here. I challenge any of you who has had any negotiations on a banking document in the last 20 years that the phrase LMA compliant or LMA style hasn't been used, even if the documents are on the bank's internal form. Keith, the LMA and Keith in particular, have had an instrumental role in LIBOR transition, liaising with regulators, governments and other industry stakeholders globally to provide guidance, draft documentation to ensure an orderly transition away from LIBOR. Also joining us is Shwade Moyd, Director at Risk Advisory in Deloitte. Deloitte has been doing a lot of work in the region on the operational and systemic elements of LIBOR transition. So working with institutions, including banks, to make sure that they have all of their systems are ready and able to work with the new reference rates as they're introduced. Finally, my colleague Ahmed Yassin, who's Senior Associate in the banking team. Ahmed has been working on a lot of projects also on LIBOR transition and has a particular expertise in Islamic finance facilities. So if I could introduce Keith.
Very good. Thank you, Matthew. That's great. And hello to everyone watching. So if we move to the next slide, what I intend to cover with you is some brief background on LIBOR transition and why it's important, a recap of the timelines and state of play per currency, dwell on some of the lessons learned from markets that are well advanced on transition, and finally some, I think, important key messaging to leave with you. The intention is to be pragmatic and practical, as well as cover the high-level points. So, turning to the transition overview on the next slide, where are we now? Well, I think most of us will be familiar with the background to transition and the compelling rationale behind it. To recap, there was, and is, a fundamental problem with LIBOR. Not just the instances of manipulation during the financial crisis, but the decreasing liquidity in the interbank market. Whilst IBORs were reformed to anchor them in underlying transactions rather than expert judgment, that liquidity challenge remained. Ultimately, regulators determined that LIBOR was unsustainable in the long term given the lack of underlying transactions. So, markets were and are recommended to move to risk-free overnight rates and rates based on those. Now, markets have been warned about transition over a number of years, what I'll call the extended or extensive flight time. And the end 2021 milestone in a number of currencies was successfully achieved, the early landings. But some areas of the market have been less exposed to transition and are in some ways playing catch up. And I think the point is that that catch up has to happen now. We should remind ourselves briefly why transition is so significant and impactful for each of your institutions. Well, it's wide-ranging. It's across products. It's across currencies. Bear in mind, it's not just about LIBOR, as other IBORs are being reformed and replaced. So do check the situation in currencies you use. Transition also has a significant impact on lending markets, whether that's how to approach and document new RFR facilities, the systems and operations needed to underpin that, or the need to transition a legacy book. Existing fallbacks may not be robust or workable, so care needs to be taken to reduce risk in the book. And then finally, and not the least important point, regulators globally have been and are very focused on this issue. They've also tended to be joined up internationally in how they approach this and the expectations of institutions. We've seen this firsthand in working groups, and this coordinated approach is unlikely to change. Let's recap very swiftly on the transaction timelines on the next slide. Now, most of the LIBOR currency and tenor panels ceased at the end of last year, except for the key US dollar tenors, 1, 3, 6, 12 months, the panels for which will cease in June 2023. There is, of course, further time for US dollar legacy transition to the end of June 2023. However, and this is important, from the beginning of this year, all new loans, including those in US dollars, should be on alternative rates. The FSB, the Financial Stability Board, has in recent statements reiterated this deadline, stating that this applies to all jurisdictions that it covers. So it's not just a US or UK issue. Other regulators, including those in the EU and Asia, have reiterated that timeline. Efforts should be being made to reduce the number of legacy transactions. Bear in mind that even though we have synthetic LIBOR for sterling and yen, this is only guaranteed until the end of the year and should not be relied upon. There is no alternative to transitioning away from LIBOR. So, on the next slide, what's happening in the major currencies? Well, different currencies have slightly different conventions and preferences for using IFRs and different approaches to tough legacy. In the sterling and Swiss markets, the clear move is towards compounded in arrear in the syndicated market, but in the US, there are a range of options available. There's term SOFR, in line with the ARC use cases, but also simple and compounded SOFR, and some continuing interest in credit-sensitive rates, although I put that essentially only in the US domestic market. Term SOFR has been widely used in US deals, particularly in the institutional market, and is appearing in the EMEA market. Compounded SOFR is also prevalent within the EMEA region, so we almost have both coexisting. In Japan, there's a multi-rate environment with TIBOR, as well as TONA and TORF. And in the Euro space, Euribor is continuing, but there is a focus on fallbacks for which compounded Euro STR, the risk-free rate, is available. Term Euro STR is also being developed, and there are specific use cases in place. So there are differences between currencies, but the options for risk-free rates and the flexibility within that are now clear, which is allowing the market to move forward. Now, what have we learned about transition so far? Well, on the next slide, moving on, first and most important, don't leave it until the last minute to get going. Experience from those markets that are most advanced has shown that working through transition takes time and inevitably leads to pressure on resources, especially legal resource. That may be even more of an issue in US dollars given the volume of legacy facilities. Operational readiness also takes time and planning. That said, much of the hard work has been done, so those transitioning now benefit from the experience of those that have gone before. There is a clear benefit, and I would advise this, in learning by testing the water and engaging early with borrowers. The next point is perhaps even more blunt. There is no choice. Tough legacy is not a permanent solution. That's very clear from regulatory messages around not relying on synthetic LIBOR, for example. With that in mind, the benefits of active transition are increasingly well understood. Being in control, making informed choices, managing timelines, and risk. As mentioned, regulators will continue to take a strong interest in the progress of transition. The risk point is very important. And to my mind, the best way to view transition is as a risk management exercise, ensuring market access, managing operational risk, reducing legacy portfolio exposure. Existing fallbacks may not be robust or workable, so solutions have to be found, and being proactive is the best way to manage transition. Now, turning to the next slide. We're often asked who should be driving the process, who should be driving the bus? And the answer is that it is a collective responsibility. Don't just rely on the facility agent or key lenders or the borrower to necessarily take the initiative. All market participants have a responsibility to transition and should be pushing for transition. You all have a voice and responsibility. Now, there may need to be some flexibility on, for example, the costs of transition that no one anticipated, but that should not hold up activity. The next important lesson is almost self-evident, but needs spelling out. Keep it simple. Follow what has worked before. Use precedents and maximize efficiency. There's a lot to do, so please don't over-engineer or overcomplicate. There is a principle. The LIBOR transition is meant to be economically neutral, designed to ensure continuity and access to borrowing. It's worth noting that borrowers may want to consider other benefits of refinancing in addition to moving to RFRs, whether that's sustainability linked, extending tenors, or otherwise. So think about RFR transition in the round. And this all comes back to ensuring the market has a good understanding of the issues through broad education. Lenders can help educate borrowers. Law firms can help lenders. Associations like the LMA can help inform. Market feedback has helped get us all to where we are now, and we continue to monitor market practice. We also have, as Matthew alluded to, extensive documentation available to support transition. This is shown on the next slide. Now on this one, I don't propose going through this slide in detail, but we have been doing a lot of work on producing new documents and updating existing ones for the transition. We have the core underlying set of RFR documentation under the LIBOR transition section of our documents index on our website. We've also produced compounded RFR versions of some of the documents in our wider suite. And importantly, we produced an exposure draft term SOFA document for developing markets towards the end of last year, which is covered in an LMA webinar. The wording for term SOFA can, of course, be adapted outside of this context if market participants choose to do so. We've also produced some practical guidance on the documentary amendment process to try and streamline it. And we also worked with ISDA on their hedging documentation for loans. I'd recommend the RFR destination table as a handy guide to finding the right document, and there's wider guidance available on drafting issues. So as mentioned earlier, the frameworks are in place, and it's now largely a function of process and execution. And to complete the picture, there are a few commercial issues to flag that may need consideration within a transition context. Next slide, please. So this is not an exhaustive list, but sets out some relevant commercial points that need to be considered on a case-by-case basis. The first is credit adjustment spreads, the adjustment added to a risk-free rate to bridge the gap to the equivalent LIBOR rate, the economically neutral point. Now, there are a number of ways of arriving at and agreeing a CAS, a credit adjustment spread, but these need to be negotiated and agreed for the transition of legacy facilities. There is also a separate question for new RFR facilities as to whether to include a credit adjustment spread or not, or simply build into the margin, and no clear pattern has emerged yet on that. The choice of permanent fallbacks for term RFR rates is still open, and may depend on the underlying market and the need or otherwise for a forward-looking rate or notice of payment. And then finally, as an overarching question, there's a need to consider hedging and any need for alignment there. Now, in wrapping up, let's finish on the next slide with a couple of key messages. And the first one, and if it's the only one that you take away, time is short. June 2023 is not that far away. It's only a year and a bit. So accept the need to adapt. Doing nothing is not an option. Institutions may be at different stages in their journey, but all need a plan for dealing with the transition and positive intent. Lenders and borrowers can work together on this. In any event, new US dollar deals, new US dollar facilities should now be RFR-based transactions, so you should all be exposed to these. And then on timing, there's no need to wait to see what happens, as much of the hard work has been done. The international loan market has good experience of transition, so make use of that. As mentioned previously, there's no need to reinvent the wheel. The frameworks are there, conventions and systems have been developed, documentation is available, so learn from precedents and good practice. And finally, and importantly, the resources are out there to help ensure a smooth transition looking forward. I'm not underestimating the work required, but the earlier efforts on transition are made, the smoother the process. So something to think about there. And at this point, I'm delighted to hand back to Matthew for the local context.
Thank you, Keith. That was really interesting. And there were a few messages coming out of that, which I think are absolutely key. One of which is timing, that there is a very limited time, as you say, with a hard deadline. So we don't have the option anymore not to do anything. And if we can move on to the next slide, one of the other comments that you made about there's been a very joined up approach by regulators internationally. There's a lot of publications, there's a lot of notices and guidance being issued internationally. The LMA has a LIBOR microsite, which has all of the latest press releases from different regulators around the world. Something which is quite telling in this region, MENA, is that there hasn't been the same level of prescriptive guidance issued by the regulators. You'll see that some of the regulators in the region haven't even given any guidance, and much of the guidance that has been given is effectively saying banks need to reach out to their customers, they need to deal with legacy contracts from end of December, no more new LIBOR related products. So it's very much putting the onus into the market to deal with this. That's neither a better nor worse approach than a more prescriptive one, but what it does mean is that we as market participants have got a lot of work to do in a limited space of time in order to ensure a smooth transition. There have been some noticeable developments in the market. So the UAE, whilst it hasn't given any formal guidance on LIBOR, is taking some steps to help support the transition. It has recently published DONIA, which is the dirham overnight index rate, which is intended to help anchor other offer rates. So just provide more clarity, more transparency, just underpinning the principle behind the RFRs, which are more closely aligned to the actual costs. Some of the banks across the region have taken a more proactive approach. Many of the banks, particularly in the UAE, have done, as Keith suggested, reaching out, helping educate borrowers with question and answers on their website. But as part of this presentation, I spoke to a number of banks across the region, and I think the picture is very mixed. There is still a great deal of work left to be done. So I will pass over to Ahmed. Next slide, please.
Thanks, Matthew. Thank you everyone for joining in as well. So I will start off with one of the more common questions we usually get from financial institutions and borrowers. That is whether compounded RFRs fall under the Sharia and general legal prohibition in the MENA region on compounding of accrued interest or return in financing transactions. As you may be aware, there is a Sharia prohibition on compounding of accrued return, or in other words, capitalizing accrued return and charging additional return thereon. Similarly, the legislation in this region prohibits financial institutions from charging interest on interest. So the question is that in the context of compounded RFRs, what does compounding of an RFR actually involve? There are obviously many different methodologies one can use to calculate interest or return using a RFR. such as the compounded balance method or compounded rate method. The LMA recommended forms of the RFR documentation incorporate the compounded rate method. Pursuant to the compounded rate method, broadly speaking, since RFRs are overnight rates and interest or return has to be calculated over the entire calculation period, it is the RFR itself which is compounded on each business day over the calculation period using the daily published rates during that period. It does not involve any capitalization or compounding of accrued interest or return. Consequently, the principal amount of the loan does not increase as interest or return accrues during the calculation period, and therefore this does not fall under the Sharia and legal prohibition. Now, moving on to the use of RFRs for conventional loans. In the MENA region, financing is either in local currency or predominantly in USD or at times at GBP. Financing in other currencies like JPY or Swiss franc is fairly limited. From a market perspective, for USD financing, either term SOFR or in non-cumulative compounded SOFR with a short look-back period, typically 5 business days, without observation shift is preferred, which is also the recommended approach by the Sterling Working Group. And similarly for GB financing, SONIA is used. For other conventional banking products, such as overdraft facilities, bill or invoice discounting facilities, and trade finance facilities, typically use of a fixed rate or forward-looking RFR, such as term SOFR, is predominant. For derivatives, the ISDA-IBOR fallback supplement and the protocol has generally been adopted. Now, going towards Islamic financing, use of overnight RFRs such as compounded SOFR is not predominant, and that's because there are certain Sharia issues to overcome. So the prime reason is actually the nature of the RFRs. That is, RFRs only have a single tenor. Compounded RFRs have a single tenor. They are overnight. And therefore, they cannot be used to calculate the amount payable in advance for a contract or a calculation period. As you may be aware, the principle of gharar requires certainty on all fundamental contract terms. For Islamic financing products using LIBOR as a reference rate, this certainty as to pricing could have been provided, as LIBOR is a forward-looking rate and therefore could be set at the start of any contract or calculation period. The same, however, does not apply to an overnight RFR. So what Islamic financiers have in the MENA region have generally preferred is to use forward-looking RFRs, such as term SOFR, as they are more or less a like-for-like replacement to LIBOR, and since they are forward-looking, can be used to calculate the amount payable in advance for a contract or calculation period. That said, Islamic structures that support the use of an overnight RFR are being developed. We have, in fact, worked with a number of banks and are presently assisting a number of banks in developing these structures. There is, however, no uniform market standard position in this region on the structure of these Islamic products. Back to you, Matthew.
Thank you, Amit. So if we can move to the next slide, please. As part of the registration for this seminar, we asked the participants to complete a short survey just for us to get a sense of how prepared the region is. We had a very good response rate. So as you can see, 300 people thereabouts responded. And we have the data behind this, and we have people responding from all across the region, from all different types of institutions. There are some fairly clear messages coming out of this in terms of going back to Keith's message about knowledge and the education piece, that there seems a great deal of work to be done in terms of ensuring that people are clear what is happening and when. So in terms of the knowledge about the awareness of LIBOR ceasing to be published, about the whole process and the timing, and then some of the other pointers towards the bottom there about systems, whether they're ready to take account of the transition. So over half still require some kind of upgrade, which is a great deal of work to do just from a technical and logistical point of view. And I think the other point there in number 2 about the level and the extent of discussions that have been held with customers by banks suggests that there is still a great deal of work left to be done. And that is consistent with the discussions that we have had and my partners have had across the region as well. That there are some banks which are still just coming to terms and trying to deal with the internal challenges of the transition before the outward facing element. But again, that's just in the context of we've got a little over 12 months for a hard deadline on this, so there's a great deal left to be done. Next slide, please. So there has been quite a dramatic increase in momentum over the last few months. This time last year and even into the early autumn, when we were repapering transactions and we were trying to negotiate the change in interest rates, we were trying to bake in a mechanism for replacement rates, and very frequently we just moved away to effectively in a rate transition event, and we will agree that at that point in the future. That's clearly ended now, and so there are far more meaningful discussions going on, obviously with new transactions, but also amending existing ones. The timing of some of these are being triggered by events or renewal of facilities or increases in amounts, but it is quite clear from the volume of inquiries that we're having that the banks are more proactively now reaching out to their customers, and equally some of the customers are also raising this themselves. Ahmad was talking about some signs of whether there's a market standard developing in terms of what rates are used, and it's probably a little bit early to tell. From the transactions we've done, some of the banks, particularly international ones, will have an agreed internal policy which they look to implement, whereas other banks are showing more flexibility depending on the preference for the customers and even the sector that it's actually in. As I mentioned, many lenders are still resolving the internal challenges prior to the client discussions. So as part of this survey and as part of just more informal discussions, and Deloitte will come onto this in terms of the work that it has been doing, I think a lot of the banks are still just formalizing their own internal policies and procedures and the systems issues before they actively go out to speak to their borrowers. And there are obviously some additional challenges there if there are syndicated facilities where you have international lenders as well as local lenders, just in terms of reaching an agreed position on the documentation there. And just repeating the point that Keith made and I mentioned a number of times, there really isn't much time left for this in terms of agreeing documentation, updating templates, reaching out to borrowers, reaching agreement on the documentation, signing CPs. So one of the key messages to take away from today is that we do need to move forward with this. I'll pass over to Ahmed for some additional considerations as well in a moment. So if we have the next slide. Before I do that, some overarching considerations for all market participants is just actually understanding RFRs. As mentioned in the survey, 51% of the respondents had some knowledge of RFRs and the transition, so that requires a great deal of education. LIBOR is a pretty simple concept. You submit a utilization request, the rate is fixed, and then that applies for 3 months, 6 months, however long it is. Our experience when we've provided draft documentation, which might have the schedules with compounded cumulative rates, it can be quite intimidating. So there is a process there of education, as Keith said, for all market participants, lawyers to work with the banks to work with borrowers, just to increase the knowledge so that all parties can go into those discussions fully prepared. Tough legacy contracts is something that was mentioned in Keith's talk about that have inherent difficulties, whether it's because the existing fallback provisions that are in there don't accommodate a move away from LIBOR, whether the amendment provisions make it difficult. But all of these have to be addressed. So a lot of this will be done on a case-by-case basis, connection-by-connection basis. In Keith's slide, he mentioned that in a couple of states in the US, New York and Alabama, there has been legislation with safe harbor provisions permitting the imposition of RFRs. There's nothing like that in the region. So just emphasizing the need for engagement between banks and borrowers to reach a concord on how to amend documents and deal with the move away from LIBOR. And then the timeline of transition. The internal policies and procedures of the banks, the documentation process, getting borrowers engaged, agreeing the documentation, providing CPs. It's all quite a timely, time-consuming process. And because there are so many transactions, so many connections involved in this, the resources on all parties, on banks, on lawyers, on borrowers, is going to be substantial. So the more lead-in time we have from now until June, the better. Ahmed?
Thanks, Matthew. So just addressing a few particular considerations from both borrower and financial institution perspective. I think the first one is, which has been touched upon by both Matthew and by Keith, and Sohaib will also be touching upon, is quite key actually, is the operational and system readiness of financial institutions, and in particular availability of systems, availability of softwares, which are able to calculate RFRs. Then obviously also internal education within the operational teams on what a RFR-based document looks like, how does it work in practice, etc. The other key consideration for financial institutions is borrower cooperation, in particular for legacy deals where there are no fallback provisions available in the loan documentation. If fallbacks are not available, a lender must consider whether the borrower can stop paying interest when LIBOR exists permanently, since there would be no interest rate. Typically, this is not the case for legacy LMA documentation, as they ultimately provide for cost of funds and margin to apply in case LIBOR ceases to be available. But this remains an important consideration for the standard bespoke financing documentation developed by bank, which are not based on LMA forms. Now, coming to the borrower side, there are a few considerations for them to take into account as well. So the first is lender discretion. Generally, the standard financing documentation of financial institutions in the MENA region provide substantial lender discretion, in particular to unilaterally select the replacement rate, make corresponding amendments to the loan documentation without requiring any consent from the borrower and by simply giving a notice. Now, from a practical perspective, lenders in the MENA region generally tend to not exercise this unilateral discretion and prefer to have borrower alignment, but it nonetheless remains an important consideration, in particular where the borrower and the lender cannot reach an agreement. Secondly, credit adjustment spread is something Keith touched upon as well. Credit adjustment spread is added on to make sure that the RFR and the LIBOR rate is economically equivalent. And as Keith mentioned, this has now become a negotiation point in financial transactions. There are certain published credit adjustment spreads by Bloomberg, but for a majority of the RFRs, there are ways to determine it, but there is no uniform market standard position on how to, in the MENA region of what it will be. So typically, it is negotiated on a case-by-case, deal-by-deal basis between lenders and between the borrowers. Thirdly is in relation to repapering legacy contracts or transitioning to a RFR, legal costs are always the concern in terms of who is going to pay. Again, there is no uniform market position on this. We've seen in certain cases, lenders requiring borrowers to bear all the costs. There are other instances where the lenders and borrower share these costs. But generally, the common trend we have seen is that a number of banks have developed their own in-house legal, in-house language, which they use in their amendment process. And these banks tend to not pass the legal costs to the borrower. So these were just certain limited considerations to keep in mind in terms of the transitioning exercise. I will now hand over to Suhaib to give his insights.
Thank you, Ahmad. Thank you, Keith. Thank you, Matthew. Thank you, Keith, for highlighting what effort and support that LMA has provided or has been providing over the years in terms of what has been done, the resources available, and also what next and what efforts that all the financial institution needs to take. Ahmad and Matthew highlighted the legal consideration in terms of the repapering, what local regulators have done in terms of the support provided to the market participants, especially the large financial institutions, and what needs to be taken into consideration while we are repapering our contracts. Now, apart from the legal and the support provided by LMA, there are multiple considerations that even within the financial institution that needs to be taken into account, apart from the legal perspective. So one of the pillar is policies, procedures, and model substrate, because as a reference rate, either it be LIBOR or any other reference rate, that is used in a financial institution in multiple dimensions, in their policies, in the models, daily accrual, MTM, and other many aspects, right? So that needs to be think through, needs to be identified and updated. And the other key element is the system change, which was highlighted by Ahmad also. That system, there are multiple systems using reference rate. Based on our experience as we have worked, as Deloitte, we have worked with multiple financial institutions across the region. We know, primary systems are, for example, treasury system and the core banking. But based on a deep dive into financial institution, our system architectures, we have identified multiple systems other than the two key systems that are usually on the tips of the management. So what needs to be done on the system, we will be covering it shortly. In terms of the communication that Ahmad mentioned, the borrower, discussion with the borrower, especially around the rate negotiation, repapering, communication is of utmost importance. First of all, to ensure a smooth transition. Secondly, to ensure from the conduct risk perspective, there are minimum complaints for a financial institution from their customers, because as a financial institution, first of all, you would not want to hamper the relationship with the customer. Secondly, you don't want any complaints or conduct risk challenges being faced by the bank on account of the transaction, on a LIBOR transition. So these are broadly the key consideration. We will deep dive into it a bit on the following slide. So in terms of policies and procedures, there are multiple policies or the procedures that are impacted by LIBOR transition, starting from the policies, right? So from the risk management perspective, you have market risk policy, you have market risk models, you have FTP, which is a backbone of any financial institution, how you are managing the relationship between the verticals of the bank, asset side, liability side, and so on. ALM policies, hedge accounting, the accounting reliefs that are provided, accounting policy, because IASB has published significant reliefs for the LIBOR transition that needs to be evaluated by the bank and then utilizing for the benefit. Apart from the policy and procedure, there are models also. For example, interest rate models, liquidity risk, market risk model, PFPs, all of the models needs to be think through it, what are impacted. And then procedures. There are multiple procedures. For example, from the treasury perspective, there is fixation, there are term sheets, there are deal capturing, curve configuration, and other so many procedures that are impacted. So all these needs to be identified well in advance, and as a management, they need to act upon how we will first of all remediate and get the concurrence. So key consideration that needs to be taken into account is first of all, identify across the bank what are the policy and procedures that are impacted. Then we need to understand the nature of the change that is required. Thirdly, the reference rate, because there are multiple options that are available. Even for USD LIBOR, there's a backward looking rate and also the forward looking rate. And there are other options that are available. So we need to identify from the bank perspective, which rate will replace existing LIBOR. And then identify the indirect impact, because on the face of it, it's simply a rate change, but there are other indirect impact. Indirect impact can be through your, for example, certain strategy decisions, certain systems that are impacted that may be missed. And then once the changes have been identified and execute those changes, get concurrence by the stakeholders. For example, for respective stakeholder, primary owner, secondary owner, and then as per the delegation of authority, to what extent any changes in the policy needs to be approved. All these needs to happen, and then formally approval of the policy so that we are ready from the policy, procedure, and model perspective, bank-wide. Now, the second key pillar that I mentioned about was the system. Moving on to the next slide. So from a system perspective, I mean, on the face of it, treasury system is of the utmost importance because that's the back, and then the core banking. What based on our experience at multiple banks across the region, so apart from these two key systems, there are multiple other systems. For example, loan booking system. Even we have experienced that CRM system was somewhat impacted. Then there are market risk system, ALM system, and the challenge is you may be running those systems, but in case you want to change anything, I mean the reference rate, how the system was set up, the existing architecture, the existing documentation was difficult to identify. And then the latest, because I assume any system was impacted some years ago, right? And then you need to do certain changes. I mean, you may find it difficult of what is the current state of the system. This is what we have experienced. So identifying the current state, what are the impacted areas of the system that are required, define the requirement in terms of what needs to be done, how it needs to be done, and how the changes will be executed. Getting the concurrence on the requirement with all the impacted stakeholders is also time consuming. And then the biggest challenge is upgrading the system. Some of the large financial institutions across the region have already initiated upgradation of key impacted system, but there are still, as observed by the response that we have received from the questionnaire, there are still organizations, financial institutions that haven't embarked on the system upgrade procedure, which is of utmost importance, because legally we may be prepared, but we cannot execute current transaction commercially until all our systems are ready. So after gathering the requirements, you need to define, negotiate with the vendor, onboard them, start the configuration or the implementation, and then the testing. Even in the testing, we have observed that there are challenges that have been identified. I mean, because this LIBOR transition to catering into the forward looking and the backward looking, there are multiple nuances in terms, even for the backward looking, there are multiple options that are available. So to what extent bank wants to have those options from the commercial perspective, this varies from the size of the bank, complexity of the bank, and also their overall strategy. We know certain banks in the region who have opted that as a strategy, we will only work with forward-looking rate. Some of the banks have adopted both, which is the backward-looking and the forward-looking. So it varies from bank to bank. But overall, a system upgrade, it's a time-consuming exercise, and it's a multi-dimensional project that needs to be initiated. Business, IT, finance, risk, all those people needs to be involved. So it has to be a collaborative exercise from the bank perspective also. Moving on. So we have covered policies and procedures. We have covered system. Now the communication management. So communication is far more important, mainly because our customer, don't think your customer is well aware of the LIBOR transition. As a bank, we need to proactively approach them that this is the LIBOR transition. As of today, we know all the information that is available, that is required for the LIBOR transition in terms of the repapering, what rates, and so on. Imagine large global GSIBs. They started this communication journey a couple of years back. By that time, information even was not available comprehensively. So for example, even what rates to use going forward was not available. But they started their discussion with the customer proactively to ensure that customer is informed, customer is educated, so that at the time of the repapering, right, when they know the specific information, there are limited challenges from the customer end. And Also, to minimize the conduct risk, so that no financial institution would want to see any challenges or the complaints to the regulator. This is of prime importance. So how we can execute in a disciplined way this whole customer communication? First of all, we need to set the governance. For example, from the bank perspective, who are the stakeholders who will be involved in terms of receiving the customer communication, customer queries, or proactively approaching them? Who will be the one who will be drafting the responses? Who will be the one who will be reviewing the responses? For example, for any response, a formal response to be released from the bank to the customer has to be vetted by compliance or no, or legal. These are the things that needs to be think through and needs to be formalized in terms of formal governance. And then the second step would be define the approach. Either, for example, there are multiple approaches that are available as part of the LIBOR transition communication, either centralized or decentralized. Centralized mainly talks about that each vertical of the bank, either for example, treasury, corporate, retail, private banking, and all others are managing their communication in the decentralized fashion. Or it will be centralized, which means there is central committee, central team who is supporting all the business units in responding to the customer queries. So it varies based on size, complexity, and the relationship of the respective business unit that they enjoy with the customer. So that needs to be think through. And also, who are the SMEs or subject matter expert who will be supporting in the responding to the queries? Because even despite the size of the organization, you may not know what industry is doing, or there are certain, for example, the challenges that are unknown. So what the GSIPs has done to respond to this, that needs to be think through it. And then after we finalize the structure and the approach, agree on the plan how we will be approaching our customer. We can approach them through FAQs that we can define as a bank and publish on our website what we have seen across the region. Many financial institutions have already developed the FAQs. Some have developed very brief, some have developed extensive FAQs and are published on the website. Some have not published on the website. What they have done, they have released it to the customer. And some are still, I mean, there is no news on their website. And then we can also, in our communication, we can refer to the links to ISDA or other global organizations that are supporting on the LIBOR transition. And then, depending on the size of the customer, how you want to reach out to the customer. Either you can organize a specific webinar for your large and major clients, or have an interactive session through the RM involving some SMEs and so on. So overall, it's a mixed program that needs to be established, and it will continue running till next year, June 2023. Till the time all the contracts are repapered, we don't see any additional customer query. Moving on to the last slide. So from the customer communication perspective, there are few things that needs to be factored into based on our experience, challenges that we have seen. For example, the resources. So what are the resources? Because for any resource, there is a cost associated, right? So we need to identify efficiently who will be involved as part of the LIBOR transition, who will be involved in the communication. Cost is a factor. So depending upon how you want to communicate, that needs to be taken into consideration. Client journey. So client journey, basically, you need to tailor your message where your client stands as of now. So either you would have started a year ago where all the client would be on the same page, but if now some of the client would have already approached you, so you cannot have a standardized communication release for all the client. You need to tailor it specific to the journey where the client is. So that is the key consideration. Fourth, the conduct risk that I have mentioned earlier also, that we need to ensure that our customers are informed, educated proactively, whatever information is available, so that minimize any challenges in terms of the repapering or even regulatory challenges. For example, if there is any complaint or the customer complaint to the regulator, there may be challenges for the bank also. The last point, that this has to be a collective effort between all the verticals of the bank. Why? For example, Any customer may have relationship with the treasury. He may have relationship with corporate banking. So we need to ensure the message is consistent from the bank to a particular customer. He may be interacting with a separate RM or one RM, but from the business unit perspective, there has to be consistency in the messaging. If not, that can create challenges. So that is from my side. Over to you, Matthew.
Thank you. That was it's interesting seeing and understanding how granular the steps have to be, because we were talking about the need to engage and just the amount of work that goes in before banks are able to even reach out to their customers. So thank you, Shoaib. Thank you, Keith. I realised I forgot to mention at the outset that we were keeping some time for Q&A. If anyone has any questions, if you'd like to submit it via the chat function. We have received one question about if a secured facility is amended to move from LIBOR to SOFR, for example, would we advise that the security is retaken or reconfirmed? It shouldn't be necessary. One of the key aspects of the transition is that there's supposed to be no transfer of economic value. So the new rate, whatever it is supposed to be equivalent to the rate that was applicable previously, whether that involves a credit adjustment spread or not, whether it's a change in margin. One of the key considerations about security and whether it needs to be retaken is if there is a fundamental amendment to the underlying obligations that would increase tenor or increase the interest rates. So we would obviously have to look at this on an individual basis, but on the face of it, the transition should be neutral economically, in which case it shouldn't have an impact on the security. Okay. But if we've got a few minutes left, if there's anyone else would like to ask a question. Okay.
I was just going to make an observation, Matthew. I guess in many ways we're in a much better place than we were a year ago generally on transition. And I think what we've learned today is that there is a pathway and there are pathways and people have trodden it before. So I think there's a very positive message to take away from this of a framework of what needs to be done. The second point, though, is I think everything takes a lot longer than you think. And inevitably, all this will get concentrated in the latter part of the timeline. And that is when there's real pressure. And particularly in dollars, there'll be a lot of pressure everywhere on resource. So it is a function of getting going, which I think hopefully is a message that everyone will take away.
Okay, thank you. We've had another question about mention that GCC regulators have provided guidance on LIBOR transition. Can more light be shed on the guidance provided by the regulators? Actually, the Central Bank of UAE hasn't issued any formal guidance, nor has ADGM. All of this is publicly available, and we can circulate it after this talk if anyone is interested. Basically, the guidance that has been published is quite summary in nature. I did have them actually with me, so just providing or just encouraging no new LIBOR transactions to be priced by LIBOR from the end of December 2021, ensuring that there is engagement to move forward, and then just reiterating the hard deadline of June 2023. So there isn't anything specific, and that was in contrast to some of the other regulators in other jurisdictions, which have been far more prescriptive in their guidance. So reiterating the point that this approach from the regulators in MENA region puts more onus and emphasis on us as the market participants to actually make sure that we move ahead with this.
So Matthew, if I may add, yes, Aman, you can add.
Yeah, I would just think that in addition to that, so like Matthew said, that the guidance is somewhat general in nature, and they've essentially provided, like Matthew said, that at the start of, at the end of 2021, no new contracts referencing LIBOR should be issued. There are, for example, in the KSA, SAMA has gone a step forward, and they have required the financial institutions in their jurisdiction to carry out a classification exercise in terms of the legacy contracts. And then they define 3 categories of contracts based on what fallbacks are available in the documentation. ranging from what level of involvement of the borrower will be required to transition to the RFR rate. And on that basis, to come up with a plan on how to transition, whether a formal amendment agreement needs to be executed, whether your current fallbacks are appropriate and only a notification is required. And then the other regulators have, in a similar fashion, requested the financial institutions in their jurisdiction to come up with a plan on what their plan is on transition. So it's more or less journal based, but nothing as prescriptive as in other jurisdictions. Over to you, Syed.
No, I just wanted to add, I mean, any regulator within the region haven't specified, I mean, or endorse any specific rate that the bank should use. They have leave it to the market participants. And this is the case with the globally also. They've left it to market participants. For example, any bank needs to decide, as one of the question is, either they should go with a backward-looking compounded SOFR or a forward-looking. So this depends, it varies from transaction to transaction, and you need to decide on a case-by-case basis. For a bank, you can take a direction that as a bank, we would do this, but there's no specific, confirmation for any rate by any regulator in the region.
Yeah, and the question is, in terms of trends that we're seeing, term SOFR versus compounding SOFR. So essentially, you can bifurcate this in terms of products. Like I mentioned, in the Islamic world, what you're seeing is term SOFR is gaining a lot of prominence because the ease of use and like-for-like replacement for LIBOR. And then there are certain banking products like overdraft facilities. We've seen that banks are preferring to use term SOFR as opposed to daily SOFR. For your bill discounting or invoice discounting facilities and trade finance facilities where there's a need that the profit or fees or interest which is payable by a borrower should be identified on the onset of the transaction, there's where term SOFR is generally being used. For general large value corporate financings, again, it's a mix and match. So we do see term SOFR, but compounded SOFR is, we've seen a lot of deals being done in compounded SOFR. And then there are various permutations within the compounded SOFR methodology as well, being with look back, with observation shift, without observation shift, or cumulative versus non-cumulative, etc.
But one would hope that during the course of this year, we'll start seeing a few more trends, so we could probably answer that more consistently. So Ryan was just saying that ARRC previously recommended term SOFR for USD transactions. I think actually its announcement, it said it is an option for certain business loans. I think Keith can probably answer that.
No, I think that's right. I don't think there's no, as has been identified, there's no sort of prescriptive use this or don't use that. I mean, I think the only thing I would say, yes, there's a wide business loans use case for term SOFR, which is very helpful, I think, for the loan market. But you also need to think about what your fallback might be to term SOFR, and you may need to be able to do compounded SOFR as a fallback. So there are different things to think about how you approach it, but there's no you have to use this or you have to use that. There are always options available.
Yeah, we can provide. There's a question there about providing some of the regulators' guidelines. Then that they are all available via Google. But if you want to reach out to me, then we can provide. I can provide them to you. So we're coming up to the hour now. So I'd like to thank Keith and Shoaib and Ahmed for contributing to what I hope has been an interesting presentation. This webinar is available on the Altamimi financial sector webpage if you'd like to see it, as are all of our contact details. So thank you all for taking part. Thank you for also completing the survey, which has actually given some really interesting data. So thank you and enjoy the rest of your day.
Thank you, everybody.
Thanks, Matthew.
Thank you, everyone.